Hello everyone, let me ask you a question. When you look at the price charts, what do you actually see? Most traders see candles going up and down, they see patterns, they see lines, but they're missing the most important piece of information on the entire chart is volume. Price is just the advertisement, volume is the actual transaction. It's like judging a restaurant only by its sign outside without ever checking if there are any customer inside. In this video, I am going to show you how to read volume correctly. Not just what volume is, but what it means, why it is matter, and how to use it to see what's really happening behind every move. After this video, every candles on your chart will tell you a story and volume will be the proof. Not financial advice, just education. Let's go into it. Let's start with the basics. Basically, the market has a two language. Every chart speaks two language at the same time. Language number one is price. Price tells you what happened. Did the market go up, down, and sideways? That's the headline, the news title. Language number two is volume. Volume tells you how much conviction was behind that move and how many traders participated it. How much money actually moved there? That's the evidence. The proof, think of it like an election. Price is the result, who won, but volume is the number of voters who showed up. If only 10 people voted, does the result really mean anything? But if 10 million people voted, that's a declaration. Same with the market. A big green candle on low volume, suspicious. A big green candle on high volume, that's a conviction. That's a real. From now on, every time you look at the chart, don't just ask where did price go. Also ask how much money stood behind that move. Now here the most important idea, core mental model, effort versus result. In this entire video, the read volume correctly, you only need one mental model, just one, effort versus result. In the market, effort is volume, how much energy, how much money behind used. Result is the candle, how far price actually moved. Think of it like pushing a car up a hill. Your foot on the gas pedal is the effort. How far the car moves is the result. Case number one, you press the gas, the car moves easily, big effort, big result, everything matches. On the chart, that's a big candle with high volume underneath. Lots of buyers, lots of conviction. The move is real, like a whole stadium standing up to cheer. That is genuine excitement. Case number two, you slam the gas pedal, the engine roars, fuel is burning, but the car barely moves. There is something blocking the road. On the chart, that's a tiny candle with massive volume underneath. This is called absorption. What's happening? Buyers are pushing hard, but there's an invisible wall. A large seller, smart money, is sitting there quietly absorbing every single buy order. Think of a dam. The water keeps pouring in, but the dam holds everything back. When the water runs out, when buyers exhaust themselves, there is nobody left to push a price up, and very often price drops sharply. Case number three, you build the gas, but the car keeps rolling uphill by itself. There is no resistance. The road is empty. On the chart, that's price moving up on low volume. This is called no supply. It's mean buyers are super strong. It's mean sellers are absent. Nobody is selling here. So the market doesn't need much effort to move, like walking on empty road. No one is blocking your path nowhere. Now here's your cheat sheet. The volume matrix, high volume plus big candles, healthy move. High volume plus small candle, absorption, warning sign. Low volume plus price still moving, no supply or no demand. The other side is absent. Memorize these three combinations. They are the foundation of everything that comes next. And now I am talking about VSA patterns. There are three types of VSA patterns: stopping volume, buying climax, and no supply. Now let's apply effort versus result to specific candle patterns. This is volume spread analysis. VSA three patterns every trader should recognize. Pattern 1, stopping volume. Imagine price is crashing, red candles after a red candle. Everyone is panicking and selling. Then you see this a tall red candle. The volume bars underneath is huge, huge, the biggest in the week. But here's the thing: the candle doesn't show at the very bottom. It has a long wick below and the close it near the middle. What happened? Someone with deep pocket bought everything the panicking sellers were throwing away. They did not stop the crash with the words, they stopped it with money. High effort, small results. The price did not go lower despite massive volume. That's absorption at the bottom. A potential reversal zone, pattern 2 buying climax. Now imagine the opposite price has been going up for a week. News is great. Everyone is bullish. Retail traders are jumping in because they don't want to miss out. Then you see a huge green candle. Volume is extreme, the highest on the entire chart. The most traded that this look like massive strength, but here's the plot twist. This is not strong buying, this is strong selling. Disgust are buying. Smart money uses that wall of buyers. Retail traders to unload their massive position. They are selling into the demand quietly without crashing the price like a vendor at night market. The busiest moment, that's when they are cleaning out the last of their stock. The moment you FOMO in at the top, that might be exactly when smart money is walking out the door. Pattern 3. No supply test after an uptrend, price pulls back a little. You are worried this is a correction. Then you look at volume, a small red candle, and volume is very low. The market is asking a question: does anyone want to sell here? And low volume answers no. Not really, that is no supply test. Sellers are absent. The uptrend is likely to continue. Like testing of the first is hot, but you put your hand near it, it's cool. Safe to move forward. Three patterns, one mental model, effort versus result. That's enough to read 80% of the what volume is telling you on the chart. Now before we go further, let me clear up the most common mistake in volume reading, and if you have been making this mistake, don't worry, almost everyone does. The myth: green volume bar means buying, red volume bar means selling. That is not how it works. Here's the truth: every single trade requires a buyers and sellers, always without exception. If you bought 100 shares, someone else sold you those 100 shares. Volumes counts the number of transactions, not which side is winning. The color of the volume bar, it simply follow the color of the candles. If the candle closed higher, that is open green bar. If it closed lower, red bar, that is it has nothing to do with who is buying or who is selling. Think of a busy first market at 5 in the morning. At 5 in the morning, the market is packed, high volume, but there are buyers and sellers everywhere. You can't say today is buying just because the market is busy. Busy means activity. To know who is winning, you look at where the candle closes. So here the don't look at the color of the volume bar, look at the size of the volume bars combined with where the candle closes, side plus close position. That's where the real story is. Now let's talk about one of the most powerful: volume divergence system. Volume divergence system. Warning signal is volume analysis. Volume divergence: when the price and volumes agree with each other, the trend is healthy. Price going up, volume going up. Strong. Price going down, volume going down. The selling is weakening. But when price and volume disagree, that's your early warning system. Here is the most important one. Imagine price is making a new highs. The charts look great. Everyone is celebrating, but if you look at the volume bars, they are getting a smaller. Each new high has less volume than the previous one. Think of a rocket at launch. The fuel is full. The rocket blasts off with enormous power, but as the fuel burns, the thrust weakens. The rocket slows down and eventually it falls. That's what declining volume during an uptrend looks like. The move is running out of fuel. Fewer and fewer traders believe in the move. Dropping two sellers are getting exhausted. Each drop has less and less participation. The selling is drying up. That often signal a bottom is forming. Volume divergence is your free early warning system. The market hasn't crashed yet, but it's getting tired. It's like the applause getting quieter after each speech. The audience is losing interest. The show is almost over when you see price making new highs but volume making lower highs. Pay attention, something is about to change. Now let's turn everything into practical playbook. Number 3 is stop volume check, a simpler process you can use on any charts, any market starting today. I call it the three-step check. Step 1, zoom out. Before you look at individual candles, zoom out to the daily and or weekly chart. Ask yourself, is volume overall increasing or decreasing? Are there any unusual volume spike recently? Think of it like checking the weather before going to outside. You want to know the climate before you worry about the rain. Step 2, zoom into the key levels. Find the important support and resistance levels on the chart. Now watch what happen when price approaches those levels. Apply effort versus result. If price touches resistance and volume spikes but the candle stays small, that is absorption. The walls is holding. Be careful. If the price break through resistance with a big candle and high volume, that's a real breakout. Effort matches result, but if price breaks resistance or low volume, be suspicious. A breakout without conviction, often a trap. Step 3, wait for confirmation. This is where most traders go wrong. They see one signal and immediately jump in. Do not trade, do that. After a breakout, wait for next candle close. Does price pull back to the broken level? If it does and that pullback happens on low volume, that is no supply test. The market tested the level and found no seller. That's your confirmation. Patience for one extra candle can save you from 10 losing trades. Let me show you how this look in practice. Price is approaching resistance. You zoom out. Volume has been steady. Price touches resistance. Volume spikes, but the candle is small with a long upper wick. High effort, small result absorption. The wall is strong. You do not buy. You wait price drop. You avoid a trap. 3 steps: zoom out, zoom into key levels, wait for confirmation. That's your volume playbook. Before you next trade, run through this quick checklist. 1 is volume increasing or decreasing compared to the recent bars. 2 is, does the effort match the result? Big volume should means big candle. If not, someone is absorbing. 3, are there any unusual spikes volume spikes near the key levels? 4 is volume diverging from price. No highs on lower volume is a warning. 5, what does the next candle confirm? Never act one candle alone. When you ask these 5 questions, you're no longer guessing. You are reading the market. You are seeing the proof behind every move, because volume is not just an other indicator on the chart. Volume is the truth serum of the market. Price can be pushed around, price can be manipulated you, but volume shows you where is real money, real commitment is stepping in. If this video helped you finally see what's behind the candles, let me know in the comments which patterns are you going to look for first. Stopping volume, buying climax, or divergence volume? Drop a comment. I'll read every single comment. I will see you in the next video. Stay disciplined.